for joining the final edition of our On Top of Tax webinar series for 2024. I'm Karen Riley, I'm a tax partner here at BDO, specialising in tax assurance and risk management. But today we're going to be talking about some key deadlines that you need to be aware of, and sharing some in-depth insights on some hot topical areas of tax. So we will allow at the end of the session today a short Q&A section, so please do feel free to drop any questions that you might have in the Q&A box that you can see there on your Zoom screen. Please do, though, we ask, please do use the Q&A function rather than the chat function. It's the Q&A box that we'll be keeping an eye on. If we run out of time, please don't worry, we'll follow up with you afterwards. Next slide, please. Okay, great. So today I am joined by Carrie Rutland, who's going to be discussing R&D claim notification deadlines. We've got Amit Dev joining us to talk about VAT and diving into e-invoicing and the future of VAT compliance. And we have Nick Duffin, an employment tax specialist, who will be focusing on and talking us through some updates and topical tax matters around off-payroll working. Next slide, please. I think we've just run through the agenda there. So we'll kick off with R&D first of all with Carrie. Key corporate tax update deadlines with Carrie first of all.
Super, thank you, Karen. So yes, as Karen mentioned, I'm a partner in the Innovation and Incentives team at BDO. So I look after R&D claims, patent box and innovation grants. But before I look at the claim notification rules for R&D, which came in very recently, I thought I'd just do a quick overview of the key dates that you should be thinking about, have in your mind, have in your diary. So 31st of December, if you're a December year end, your corporate tax return needs to go in. Your corporate interest restriction return goes in. For companies who are newly in scope, they need to publish their corporation tax strategy. And there are R&D claim deadlines. So the normal CT deadlines, original return, 1 year after the end of the accounting period. Amendments can be made up to 2 years from the end of the accounting period. So if you're doing an R&D claim for December 2022, it must go in by 31st of December, otherwise you're simply out of time. The other thing which I'll talk about in a little bit more detail in a second, R&D claim notifications. If you have to make one and you're a June year end, for your 23-24 year end, that needs to also go in effectively by Christmas, so 31st of December. 1st of January, December year end companies, the R&D merged regime now applies. That's got some fundamental changes, particularly if you're subcontracting or contracting out your R&D, or if you've got overseas workers, overseas people included in your claims currently. So just be aware of that. 14th of January, CT61 assessments, interest and royalties for the quarter to 31st of December. So that needs to be done. And 31st of January, online marketplaces reporting. So that's your eBay, your Vinted. The companies need to report to HMRC the trades that have gone through on their marketplace. So busy times in the world of corporate tax, just in the next month or so. So yeah, no let up really. Next slide. So what I wanted to talk to you today about was the R&D claim notification deadlines, as these have been recently introduced by HMRC and are sort of changing the way new claimants make R&D claims. Next slide, please. So why were the R&D claim notification rules introduced? It's part of a broader scheme from HMRC to reduce the amount of fraud and error in the R&D regime. There's been a lot in the press about actually people making claims who weren't entitled to claims, or people just basically not understanding the rules. And HMRC is on a mission to improve the claims that they receive and to improve the compliance levels. Awful lot of changes going on over the last 18 months, and claim notification forms just one part of that. Next slide, please. So what is the R&D claim notification requirement? So the claim notification basically gives HMRC advanced warning that companies are intending to submit an R&D claim. And this is particularly relevant for companies who've never claimed before or don't have a recent claim history. And it begins for accounting periods beginning on or after 1st of April 23. And as I mentioned, it's part of these measures to improve R&D claim compliance. How do you submit your claim notification if you're within scope? There's a dedicated HMRC portal. So you can't email HMRC sort of incentives email address. You can't go to your customer compliance manager. You have to use the dedicated portal and fill in the form in their format. That's the only way you can notify. So when do you need to notify? Who's in scope? If we look at the next slide. Okay, so this flowchart is really sort of your basics and what you need to look at, and will hopefully guide you through whether or not the rules apply to you. So the key thing, it's for accounting periods beginning on or after 1st of April 23. So if you're submitting a claim that relates to an earlier period, so say you're doing a December 22 claim, then you don't need to pre-notify it. It's earlier than that period. If you are within the scope, so it's a claim after April 23, you need to look at whether or not the company has claimed before. If they've never claimed before, you need to notify HMRC that you're intending to make a claim within 6 months of the end of the accounting period. So if my year end is June 24, I need to submit my notification form by the 31st of December 24. If I don't submit my claim notification form when I should do, then basically my R&D claim, if I submit it at a later date, will automatically be struck out of the tax return by HMRC. And there is no mechanism for you to say, oh, I forgot, or oh, I'm ever so sorry. It's an automatic strikeout and there is nothing you can do about it. If you've made a claim before, you get into some quite complicated rules about actually, does that claim count in my my 3-year look back, or do I still need to notify? So the simple basic rule is if you've submitted a claim in the last 3 years prior to the claim notification deadline, you don't need to submit a claim notification form. However, if that claim was made in an amendment to the tax return, and that amendment was after the 1st of April 23, so that's that box in the black at the right-hand side, then that amended return doesn't count. So effectively, you have to ignore that in looking at actually, have I made a valid claim in the last 3 years? So that's where it becomes slightly complicated. So if we go on to the next slide, please. I absolutely think it's easiest if you draw yourself a timeline and work it out. So if we take a 31st of December year end, so it's relevant for accounting periods starting on or after the 1st of April 23. So that is your 24 year end, because your 31st of December 23 started on the 1st of January 23. So for your 31st of December claim, you go forward 6 months to 30th of June, and then you look back 3 years. So that is to the 30th of June 23. Did you make a claim that wasn't via an amended return in that window? If you did, then you don't need to notify HMRC. If you didn't, then you need to do that notification form by 30th of June 2025. So as you can see, it's quite complicated, which is why absolutely I recommend drawing it out. I think we've got another example, which is just talking about March year ends. Absolutely same principles apply. Work out when your first accounting period starting on or after April 23 is. When does that end? Add 6 months on and then go back 3 years. If in doubt, very happy to answer any questions on it. Reach out, ask me questions, and we'll help guide you through. Have you got a valid R&D claim that will count? Do you need to pre-notify? If you're at all unsure, there is no downside in pre-notifying. So whilst I don't recommend swamping HMRC with notification forms, if you're unsure, put that notification in, because that just protects your ability to make a claim going forward. Next slide, please. So what do you need to include on the notification form? It's not a massive amount of detail, but it does need to be right. So the contact data for your company, senior R&D contact, so name, email address, telephone number. If you're using a tax agent, the name of that tax agent, so that HMRC's got that got that awareness. Accounting period date, and a summary of the high-level planned activities. So a flavour of the types of projects that you've done in the last 12 months that you're going to be making R&D claims for. And that's where it's important. If you think, what's the claim notification form trying to do? It's putting HMRC on notice that you're making that claim, so that it can inquire into it. HMRC can inquire into that claim if it doesn't feel comfortable. So if your summary of the planned activities is too high level or doesn't give a feel of why it's qualifying R&D, you've upped the likelihood of an inquiry. So you need to be sufficiently sort of technical in it without providing them volumes to make them feel comfortable. Actually, this is going to be a genuine, valid claim. I'm not going to immediately put that one into inquiry. So just make sure that summary is sufficiently sort of, robust and technical. Next slide, please. So just some things to watch out for. Obviously, I've talked about if you've never made a claim before, that the claim notifications are really designed for you. I've talked a little bit about amended returns. When was the amended return made? If it was made after the 1st of April 23, it doesn't count in that claim notification window. So whilst you might think you don't need to put in a notification, you might actually need to do so in practice. Long and short accounting periods are complicated, and I would definitely sort of recommend talking to somebody, getting advice on that. The simple thing, if you've got a long accounting period, the notification deadline is 6 months after the end of the long accounting period, but you may actually need to do 2 notification forms for each period of account from a tax perspective, one for your 12-month period and one for your stub. So that's why I say long and short accounting periods are slightly more complicated. The other thing to watch out for is if you're doing transfer of trade and assets, hives up of businesses. So whilst the group has made a R&D claim before, that particular legal entity hasn't. These rules apply on a legal entity basis. So if your particular legal entity hasn't made a claim in the last 3 years, it will need to pre-notify, regardless of what the rest of the group's done. And the other thing I would just watch out for is acquisitions and due diligence on acquisition. Has that notification form been made? Is the R&D claim valid? So these are just a couple of a bit of some highlights into the claim notification rules. Key messages: if you're intending making an R&D claim within that 6-month window after the year end, just check, do I need to notify or not? And make sure you're certain before you proceed. Next slide. So just thought we'd run a sort of a quick poll on the claim notifications. So brilliant. Do the new R&D claim notification requirements impact your business? So feel free to vote. And then we'll share later on the results of the votes and just where people have got to. And the second question is, how prepared are you for the claim notification requirements? Super. Well, I will hand over to Amrit now, and he can take you through. So I guess what we're seeing is that the claim notification requirements apply to about a quarter of people on this poll, and that roughly half of people are prepared for them, which is quite interesting. But yeah, I'll hand over to Amrit now.
Thank you, Carrie, and morning, everyone. So I'm just going to go through the e-invoicing aspect of this session. If we go to the next slide, there is a couple of things we want to mention on some key deadlines that are coming up, especially with the festive period. Also, just want to just reconfirm that our team specializes in tax technology. So that's why we're focusing on this session today. In terms of key deadlines, so the first one is coming up 31st December. So that is for essentially large businesses who pay their VAT on installments, so payments on account essentially, where it's above a certain threshold of 2.3 million. So that's quite key, not to miss that one. And then straight after, in the EU. Not sure how many businesses will be impacted by this, but there are some new rules that the EU are putting into force, and that's around online entertainment and cultural and education type events. So that's a big shift change in terms of how that is accounted for. Essentially, where it's B to C, especially, then what may happen going forwards from that date is potentially that will be due in the member state where the recipient belongs. So that's probably one to look into in more detail if you might be impacted. Shortly after that, you've got 7th January, your usual kind of monthly, quarterly VAT return due and payment amounts due as well, where you're in a payment position. And then at the end of the month, in the new year, we've got the CBAM, CSOP, and PPT returns due for 31st December. And then again, you've got your next installment payments for that where you're large or within the annual accounting scheme. So moving on to the main kind of segment area on the invoicing. Again, not sure how many are impacted by this, but essentially, given that Rachel Reeves, the Chancellor, announced early next year to hold a consultation on e-invoicing, I imagine at some point in the near future, most businesses will be impacted by e-invoicing, if not already. But in terms of going through what e-invoicing is, what I like to make quite clear straight away is it's not a PDF invoice. So PDF invoice is a digitized version of a paper invoice. And essentially, it's still a paper invoice. What a e-invoice is a bit of code. So I think most people probably would have heard of XML, especially if they're involved in corporation tax preparation. So XML code is utilized to essentially detail all the elements of an invoice that you would normally have on a paper invoice. So that's the standard that is generally utilized in e-invoicing in the e-invoicing world. There are some other standards such as JSON as well, but it tends to be XML. And what happens is the supplier, for example, would send this XML code to the customer, and when the customer receives that XML code, it would make a direct entry into their system. So if you think about the journey of the traditional kind of even PDF invoices, firstly, that would need to be created by an accounting system in PDF format. That's then maybe emailed over to a central inbox at the customer side, and then that would then need to be processed somehow. It might be manual, where they literally take the PDF and then there's entries made in the accounting system on the customer side, or there's some sort of bot or automation that happens that just mimics those manual kind of entries. Whereas with XML, it's a direct entry. It just happens essentially. So that's quite an important concept to kind of get to grips with e-invoicing. But there are some major benefits because of that. So the reason why a lot of governments around the world are pushing this, including the UK, is the perceived reduction in the VAT gap. So the VAT gaps are quite big around the world. So even in the UK, it's around eight or nine billion or so, so quite big. It reduces the onset of tax evasion as well and fraud. But there are some niggle points. So if there's any gamers on here, you'd probably remember the kind of format wars, so to speak, that you had between, I think it was PlayStation and Xbox at the time. For example, Blu-ray and HD DVD, I think it was called, going back a while now. So there's similar type of approach with e-invoicing, which is a bit odd. So what we've ended up with is a number of different networks that do different formats, but we won't go into too much detail now, but it's just so that you're aware. And then through the whole concept of essentially sending a bit of code and it leads to a direct entry into systems, there's opportunity for quite significant cost savings because essentially you can automate the whole process in terms of AR and AP, and you can even take it further to the whole of the order to cash process or the P2P process as well. And the likely kind of aspects to consider because of this is essentially organizational change. So there's some key kind of concepts we wanted to cover uh, um, on this. So if we go to the next slide, please. And talking about the different networks. So don't expect you to get this straight away, but this gives you an idea of around the world, there are different models in operation. And this is probably accurate from about a few months ago, so it may have changed slightly. So no need to pay too much attention to different countries, but just to give an example of how different kind of regions and different countries have taken a different approach. Even within the EU, you probably notice straight away there are different takes to how e-invoicing should be implemented. So if you take, for example, Italy, which has a centralized approach, because their fraud was so rife at that point and there was a massive VAT gap to reduce that substantially with which they have now, they took a centralized approach. So if we just take a centralized approach, what happens there is the supplier actually needs to send their invoice to the tax authority. That then needs to be essentially certified and cleared. And once that's cleared, the tax authority then sends that to the customer. So there is actually no interaction between the supplier and buyer or the customer in that model. And essentially all that data, AP data, AR data, is received by the tax authority. So that's a centralized approach. Whereas in other regions, you have the complete opposite. For example, in Finland and Switzerland, the first model, you essentially have a completely decentralized approach. And what happens there is you have the tax authority just lets the supplier and the customer just get on with it, really, like you have now, I guess, in the UK, where you do need to essentially exchange data, invoice data through e-invoicing mandates, uh, but you're kind of free to use whichever provider there is. You don't need to send that data to the tax authority. So it's a bit of a different model. And then you do have some hybrid models, such as a decentralized approach on the far right as well. So slightly confusing, but this is the lay of the land, so to speak, around the world. There's different models, which can confuse things a bit. If we go on to the next slide, please. But if we focus on Europe, because there are some key kind of deadlines to think about there. So in terms of mandates that are already live, you have Italy, Romania, and Greece, and then planned for early next year is Germany, especially, and then you've got Spain, Portugal, and Latvia, and then after that in 2026 onwards, you've got France, Belgium, Slovakia, Poland, and Croatia, and then obviously you've got the e-invoicing consultation in the UK due to be published early next year. So the UK may be on the map very soon as well. And then you have this concept of VAT in a digital age, which is another game changer. So you've got these different models, and the idea of VAT in a digital age is to harmonize some of these models. It doesn't completely harmonize, so you won't have just one model in the EU. You still potentially have these different models, but they should be harmonized in terms of the data requirements. So it should hopefully be a bit more simpler from a systems perspective in terms of what data you need to capture in your systems. But that's not going to come in until probably 2030 or so. If we go on to the next slide, please. So hopefully I haven't just confused you now, but you might be wondering, especially if this impacts you, where do I start? So as we've been speaking about this to businesses on a one-to-one basis, what we tend to recommend is firstly the first step being looking at your e-invoicing profile. So to check which countries you are in, which countries you are established is quite important, because in many jurisdictions, if you're not established in that country, then you're not caught by the rules. So it's very important to understand, are you established from a VAT perspective in that country? And if you are you therefore caught by the rules? So if you can then see how many countries you are caught by, then you can go on to think about your data requirements. What type of data do you need in your system? Is it sufficient or not? So you may need to review your master data once you've understood the technical kind of mandates. And then it's about, okay, so now I need some software, because you're going to need some software to generate this code, this XML or JSON code, to then send over and connect in certain jurisdictions to the tax authority, such as Italy, for example. So you're probably going to have to most likely either purchase some third-party software or engage your current software provider, depending on your system, to essentially add a bolt-on to enable e-invoicing directly from your systems. And there's only a few that can do that. For example, SAP, JD Edwards, and maybe a few others can, but majority can't at the moment. So through that understanding, it's then important to know, if you've only got, for example, a couple of jurisdictions and you don't expect to expand anytime soon or even in the future, then maybe you can have a couple of local point solutions. But if you've got quite a big coverage or you plan to expand globally, then you're probably thinking about, okay, I need one provider that can service all of these jurisdictions. And there are a few providers at the moment on the market. There's probably three really that are truly global. So it's worth speaking to them as well. And then once you've done your systems review, understand all your mandates, you know your profile, and you're ready to go, you then can go for implementation, where you essentially connect your systems to the provider. Might be a third-party platform, or it might be actually just an extension of your system, a bolt-on. So you go through that implementation process, then you should be ready to send and receive e-invoices. Is there another slide for me on this one, or no? There we go. Okay, so that's all I wanted to cover for e-invoicing. So thank you for listening, and I'll hand you over to Nick. Thank you.
Thanks, Amit, and good morning, everybody. My name is Nick Duffin. I'm an employment tax principal based in our Manchester office. And whilst I have a wide interest in all matters to do with employment taxation, I do have a particular interest and specialism in the use of off-payroll workers. Before we get into that, next slide, please. As with my esteemed colleagues, we've got a few key compliance dates to consider over the coming weeks. Firstly, the 19th of December. It is the pay date for your monthly RTI remittances of PAYE and National Insurance. As you're probably well aware, the 19th is if you're paying by cheque. If you decide to pay by bank transfer, then you do have until the 26th of December. The next key date is the 7th of January, and that is the date of which, if you've not yet filed your employment-related securities annual return for 2023-24, which should have been due on the 6th of July of 24, then there'll be a further penalty. So it would be encouraged, if you haven't yet done so, to make sure your filing is then up to date. We then move on to the 19th of January, where the next set of monthly RTI payments are required. Again, if you pay electronically, it's due by the 22nd of January. And then finally, the 2nd of February, which is the deadline date for advising HMRC of any changes to the company car fleet that you may operate for your employees. Now, that's for quarter end to the 5th of October. Next slide, please. So today I'm going to talk about off-payroll working and some of the compliance obligations that are sat within that space. I thought to start off with, it would be useful to play a bit of context and what do we mean and why it's important. Off-payroll workers cover anybody that you use as an individual who is not on your payroll, i.e. not taken on and hired as an employee under an employment contract. Why are we seeing more organisations use it? What's the attraction? Well, quite often it's to do with flexibility, the ability for a business and organisation to be able to flex their resourcing on labour to meet the demands of the business. So a new contract is won, and the use of off-payroll workers to quickly resource that particular contract to allow you to meet the deadlines agreed with your customers. So that flexibility of being able to match the resource to your need requirement, rather than having individuals who are potentially employed but not able to actually deliver any services because there's no work for them, and then the pain and difficulty of maybe considering redundancies. That flexibility is something we find a lot of our clients and contacts do appreciate. The next part of that, I've been able to easily source the best candidate to meet the requirements and needs. So using off-payroll workers to find and isolate a particular type of skill set and quickly get them on board to allow them to start delivering their services to help your business. The other part of this is also candidate preference. So in recent times, we've seen more individuals choosing to work as a temporary labour contractor to undertake discrete projects to fit a lifestyle need, or just because of other reasons that they prefer to be able to move around and have other experiences. So we see a lot more interest from candidates actually wishing to supply their services in that capacity rather than going through a traditional employment arrangement. There's a variety of sourcing models in the market, but the four key ones are, as listed here, a personal service company, which for the avoidance of doubt is a limited company, which the worker is the shareholder, owner and director, and they utilize that limited company to supply their services to their customer, in this case the end client. Agencies, so employment businesses that spend their time seeking out suitable candidates and then onward supplying them to the end client. Usually have quite large databases of suitable candidates. They may be specialists in certain sectors, but generally their purpose is to identify suitable candidates for your particular needs. Umbrella companies, these are organisations which will employ candidates, off-payroll workers, and will therefore operate PUI and national insurance on payments that they receive, but would onward supply them either directly or indirectly to the end client. So the worker is an employee of the umbrella company and then delivers their services to the business which needs them. And then finally, perhaps one that most people will be familiar with, self-employed individuals, often referred to as consultants. So these individuals who simply wish to engage directly on a personal basis to supply their services. So one thing to bear in mind as I run through the next few sort of slides is just the level of confidence you have around whether you're meeting all the obligations, because each of those particular sourcing models have their own set of compliance requirements, and some are interlinked, some are individual, and it'd be useful to sort of just bear that in mind as to how comfortable you are that you're meeting them for the different models. Next page, please. So why do you want to talk about off-payroll workers? What we are seeing is that there's quite a bit of pressure on employers at the moment, organisations who have employees. The autumn budget announced an increase in the employers' national insurance rate of 1.2% with effect from 6th of April 25, which in itself is a cost that needs to be then budgeted. But it was further compounded by the announcement by the Chancellor that the actual threshold for which from when an employer's NIC needs to be applied would be reduced from 6th of April 25 from £9,100 to £5,000. That in itself has an impact that, if nothing else changed, that's an extra £615 per employee per annum of cost that the employer would have to find through a national insurance cost charge. So a bit of a shock there. You then had an announcement that the government was seeking to introduce a new compliance level for workers supplied via umbrella companies on the back of some actual and perceived abuse of umbrella company workers by certain operators. There was a feeling that there was some underpaid pay-as-you-earn national insurance, which should really be remitted to HMRC, and the Exchequer couldn't really stand this non-compliance any further. So as ever in these cases, where there is perceived non-compliance across a sector, they seek to introduce anti-avoidance measures. Those measures are due to come in from April 26, but one of the key components of the notice was that any incorrect pay-as-you-earn national insurance could actually find themselves being falling on the books and the responsibility of the end client, i.e. the organisation that wants to use the worker. And then as part and parcel of that, a wider sense that they would expect employers, that's the government, to undertake further due diligence of their supply chain of workers. So something which we had anticipated for a while, but they'd actually come out and said that they do now anticipate and expect employers to undertake a level of diligence to ensure that any worker that they engage directly or indirectly through off-payroll working models is appropriately paying the right levels of tax and national insurance. There are other pressures we've seen which were not announced in the budget but we're aware of already. National minimum wage increase from April 2025. For those over 21, going up by 6.7%. For those in the 18 to 20-year-old bracket, going up by 16.3%. And for those 16 to 17-year-olds, going up by 18%. These are increases that quite substantial and adds further pressure to employers when they're looking to effectively manage their cost base. Also on the back of the Labour Party's success at the general election, they had announced they wanted enhanced worker rights from day one. They are shortly to be legislated, and we anticipate that that will be a further pressure on employers, if not a direct cost per se, then certainly a potential to increase the pressure on an employer in relation to providing those day one rights. And then finally, the overriding cost of living crisis, which is affecting a large number of employees, and the pressure that then puts indirectly on employers to try and help those employees manage that particular issue. What this means is we are seeing in typical historically positions, we would see that where these pressures arise, employers decide to look at alternative methods of labour resourcing. In this case, a greater use of off-payroll working models to help them source their labour. Next page, please. So I'll quickly run through the risk areas that we sort of see for the four main models. You may have heard of the IR35 reform rules. These are the rules introduced from April 2017 for public bodies and April 2021 for private sector organisations that are medium or large. That those organisations must identify any worker who is supplied via a personal service company, must assess their status, issue a status determination statement to the worker and anyone else in the supply chain where relevant to confirm whether or not that individual is within the scope of IR35. In other words, would they be an employee? Were they directly hired by the end client? Where they are within IR35, there's a requirement on the organisation to apply POI and national insurance deductions, and that organisation is the one that actually pays the PSC for those services. Once a business has identified and undertaken a status assessment, the next part is how would you monitor the ongoing use of those particular individuals in PSCs? Where do you get to when contract extensions or changes in the service deliverables? Does that affect the IR35 assessment you've undertaken? And why is this important? Well, if you fail to do any of this in a reasonable manner, then HMRC will simply say you become liable for any tax and national insurance which is underpaid because you've not taken reasonable care in applying the legislation. Then moving on to self-employed individuals. This is not new. It's been around for more years than I've been involved in tax, but quite simply a similar principle. Where someone is self-employed, where the end client is hiring that self-employed individual, have they identified all those self-employed workers? Have they considered whether the relationship with that individual is one of employment or self-employment? Where you've decided that they're self-employed and are paid gross, i.e. outside your payroll, on what basis you made that decision? Is it up to date with current thinking and case precedents? And what level of evidence do you have that it's the right decision? Again, where you've incorrectly applied those rules, there's a risk that HMRC would seek to recover any underpaid tax and national insurance directly from you as the engaging party. Next slide, please. So where you source your off-payroll workers from agencies, one of the first key tests is to understand are any of those workers supplied actually in personal service companies? Does the worker use a personal service company to engage with the agency who then onward supplies those workers to you? If yes, then you should have applied the IR35 rules, considered if the IR35 applies, and issue a status determination statement to both the worker and the agency. Whether it's a PSC or any other sort of worker supplied by the agency, Who actually pays that off-payroll worker? Is it the agency, or is there someone else in the chain? Have you established where there's more than one party to the chain? Who are those parties, and where are they based? For example, is anyone in that supply chain outside the UK? And there are further risks where you use offshore companies for supply of labour, which potentially could mean you being liable for underpaid tax and national insurance that arise. But actually, there's a wider CCO risk, as noted there, that if you haven't actually understood your supply chain, there's a potential for HMRC to see that you haven't applied reasonable measures in understanding where the workers are being supplied. Next, what is the umbrella workers? I've already explained what an umbrella company is. It's an organisation which employs temporary labour under an employment contract. But actually, the key points here is, are those workers actually employed by that umbrella company you're engaging with, or are they actually someone else in the supply chain who is employing them? The next question you should ask yourself is, well, any workers that you are using, supplied by the umbrella company, are those workers receiving all their pay as earnings? It may seem an obvious question, but in the past we've seen arrangements where umbrella workers are being supplied, and then it turns out that they are receiving a combination of a modest amount of pay and then some form of loan arrangement. So there's some anti-avoidance legislation there which needs to be considered, and potentially you, as the end beneficiary, the business that's using that work, may find themselves at risk of a claim for underpaid tax and national insurance. Again, back to CCO, what reasonable steps are you taking to ensure that the correct amount of tax has been applied? There's another part in there for umbrella workers as well. There's an extra step in terms of ensuring that where an umbrella worker is in receipt of expenses, there is a step called an SDC, or Supervision Direction and Control check. And it's quite simple to stop temporary labour workers receiving expenses which would ordinarily not be available to someone who is in a permanent employment relationship with you as the end client. And quite simply, if you as the end client exert or have the right to exert supervision, direction, control over how the umbrella operates or provides their services, then that individual should not be in receipt of tax and NIC-free expenses for travel to and from the location. Next slide, please. So we talked about the sort of four broad models or types of off-payroll workers, but I think what's really important to understand is that the focus on off-payroll workers and the compliance requirements remains very high. If you're a large organisation that is within the BRR Plus regime and you have an annual review by HMRC, there is a specific section within the exercise which asks for a level of detail on how you use and manage your compliance obligations for all varieties of off-payroll workers, irrespective of whether they're sourced directly or indirectly by third parties such as agencies. Similarly, if you're a business which is not within the BR Plus regime, but is subject to a HMRC employer records review, then there's a level of detailed questioning around your use of off-payroll workers, again, to establish what sort of behaviours you are exhibiting and how you're managing your compliance obligations there. We have seen in the last few months HMRC success with the HS2 business agreeing a large settlement just in excess of £6 million for incorrectly applying the IR35 rules and failing to take reasonable care. You then got further challenges around the IR35 cases, which are being referred back to first tier tribunal on appeal, as the Court of Appeal deeming that the first tier have erroneously applied the rules, quite often in cases where HMRC have lost at first tier, upper tier, and then gone to appeal, then been bounced back to first tier to be heard again. We're also seeing a couple of specific HMRC spotlights in relation to non-compliant umbrella companies, resulting, as I mentioned before, in the intention to legislate from April 26 to make sure that compliance is complete. And then finally, in relation to the IR35 reforms, as part of the Guide for Compliance series that HMRC are issuing, the GFC4 is a comprehensive document which notes how HMRC expects any organisation to effectively manage all their IR35 compliance obligations. It's quite substantial, and it clearly states how HMRC expect a business to apply and evidence that they've applied the rules correctly. Next slide, please. So, given what I've just talked about and all those compliance obligations, a quick poll. How confident are you that you're meeting all your obligations for the use of off-payroll workers. First one, very confident you're meeting all the obligations. Fairly confident you should be meeting all the obligations. Well, not confident at all. If you'd like to let me know what you think, and see what those results are like in a moment. Okay, so very small proportion, not very confident, but it's nice to see that most are fairly confident that they are managing their obligations, and just under a quarter very confident. I think given the complexity of the rules and the fact there's a variety of different sources of off-payroll workers, it's something where you need to keep abreast of all the changes and make sure that your processes and systems are able to flex with those changes. But if anyone's got any specific questions about that, then please feel free to reach out to us after the event. On that basis, I will pass you back to Karen.
Thanks very much, Nick. I was just going to open up to Q&A, but actually, Nick, I think the first one that's come in there is actually for you. So the question that's come in is, if you're engaging a self-employed individual via an agency, does the agency take the risk of ensuring correct tax payment? Does it rest with the agency, or could it flow up to the end user?
So self-employed individual, if you're being supplied through an agency, the agency should bear that initial risk, though they may ask you questions around the nature of the relationship you have. If you provide information which impacts a decision taken by the agency not to apply a pay-as-you-earn, then you're potentially at risk of a claim for underpaid tax and national insurance.
Great, thank you very much. We've got a few other questions just starting to flow through, and I've got a couple of questions actually just from listening in on the content today. But just before I raise those, I just wanted to share a very brief clarification in relation to the requirement to publish a tax strategy. I know earlier on in the session we had a schedule on corporate tax deadlines, and it was just to clarify on that one that any company, whether it's already in the scope or newly in the scope of the requirement to publish a tax strategy, which is broadly where aggregate UK turnover has breached 200 million, whether a standalone entity or part of a UK group, or where you're part of an M&E group where global turnover goes over 750 million euros. There are some asset tests in there, but if you are either in or newly in, you equally have a requirement. So where you've got a 31st of December year end, it's an in-year requirement. So all companies would either have to newly publish or republish by 31 December, and it's a strategy that relates to all of your UK taxes. So I just wanted to provide that clarification. I think we've got another question for Nick there, which is, we use agencies to supply entertainers and assume that agencies may cover soft such as IR35. So what needs to be done to ensure that's the case and that there's no liability arising?
Okay, so it's slightly complicated given you're talking about entertainers, but ultimately, if we go back to basic principles, the agency may state that they are dealing with the IR35 matter. The reality of life is that if you are actually requiring a personal service of the individual supplied by the personal service company, then you as the end client must undertake the assessment. You can't subcontract the responsibility to someone else. HMRC would expect you to undertake that assessment yourself and to make that final decision.
Okay.
Okay.
And just one other question actually, Nick, that I had just listening to your section there. So you mentioned HMRC success in the HS2 case. When do you think it's likely that we might start to see cases of HMRC seeking settlements or to challenge on the private sector for failing to correctly manage the IR35 reforms for private sector?
Yeah, it's a good question because our reference point is the public sector reforms which were introduced in 2017, and it was broadly 2.5 years after that introduction we started to hear and see settlements being agreed with those public bodies, such as NHS Digital, and also the the Department of Justice. I think that's the right phrase. I might have got the wrong phrase there, but effectively a government organisation which hadn't correctly applied. So 2.5 years, 3 years from the inception was when we started to hear about those cases. We're aware that HMRC are entering into inquiries with larger organisations that are private. So we would anticipate that from any point now on, we would start seeing those cases becoming aware of those cases, should I say.
Yeah, and I think it's interesting actually, because it might also link to such as the senior accounting officer regime. So where companies are in the scope of the SAO regime, where they've got to annually certify whether or not they've got appropriate tax accounting arrangements, we often see qualifications being made in relation to some of those risk areas that you mentioned before, and where some of those risks aren't being appropriately managed or addressed. So, and we are starting to see a bit more connection between where qualifications are made on SAO certificates, that's for large businesses, and compliance activity. So you've got a couple of things there maybe coming together around the same time. I think that might have an influence as well.
I think you're right. Yep.
Great. I'm going to go to Carrie next, actually, if I can. So I think it was interesting just listening to the notification deadlines on R&D particularly. And I think for businesses, there are often so many deadlines for different obligations for businesses to remember, whether tax or otherwise. What happens if a business misses a claim notification deadline? Is there maybe a way to escalate it or to obtain an exemption of sorts?
Unfortunately, this is one area where there's absolutely nothing you can do about it. So there is no escalation route. You can't go to your CCM if you've got one. Basically, there's nothing you can do. You just miss out on the R&D claim for that year. So if I was a company, what I would do in my year-end timetable, I would put in, work out if I'm going to do an R&D claim for that year, and submit that claim notification, just so that you've got the reminder in there, because it doesn't need to be onerous, but it absolutely needs to go in.
So really, really important that businesses have that structure then to make that notification on time. Okay, yeah. Great. I'm going to go next to Amit. So you had a really, really illustrative slide up earlier that showed the different e-invoicing models. And I appreciate it might be a little bit speculative at this stage, but which model do you think the UK might be leaning towards following their consultation next year?
Thanks for that question. So that's quite an interesting one. Quite a few businesses have actually asked that question. So given, I guess, the UK's culture and the way HMRC has approached things, for example, with MTD for VAT was going to be, real-time reporting, and it's going to go with a big bang, but then it essentially got quite watered down. So probably where we'll land is some form of kind of decentralized approach where businesses essentially have to send and receive e-invoices between each other, but then they don't need to send it to HMRC initially anyway. One thing I would say, which I don't know if people are aware actually, or businesses, is that in the legislation for making tax digital, there is a bit of wording in there that enables HMRC to request what they call supplementary information. So what might happen is you might have this decentralized approach, and then when they come to a compliance review, they may then start requesting this data, this granular data, because it'd be more readily available. That's what might happen, but we'll have to wait and see.
Thanks, Emma. That's really interesting. I don't see any more questions in the Q&A function at the moment, but if you do have any questions, please do feel free to pop them in the chat. I suggest perhaps we move on to the next slide while we might wait for a few more questions to come through. Just while you're having a think about any questions, just wanted to share some information on some upcoming tax-related events that we have on. So into the new year, we have our first On Top of Tax event for 2025, where similar to our approach through this year, we'll have a team of tax specialists and experts who are going to be exploring key insights for corporate employment indirect taxes, helping you to navigate change and stay ahead of the curve if changes might be potentially relevant to your business. Then into early February, we have the second part of our Navigating the Changing Landscape of Tax Governance, Risk and Compliance, entitled Building Your Tax Operating Model and Managing Tax Risk. This is a webinar series that is exploring elements of what a successful tax function looks like from structure, processes, technology, and people and talent. That follows on from the How to Be a Good Large Business event that we did earlier in December. Then a little bit later in February, we've got our next in our supply chain resilience series called Building Supply Chain Resilience Technology and Data, which will be focusing on how technology and data can transform operations and create value for your organization. And then we move into our next On Top of Tax, which is going to be a special edition of our webinar series focusing on employer year-end reporting. So just before we go on to our final slide, I have just seen another question come through that I think we might just have time for. And Nick, it's one for you. So the question that's come in is, please can we remind the name of the guide for compliance relating to IR35? Is there specific guidance that we can point to help businesses, please?
It's Guide for Compliance 4. If you push that into a search engine, you'll see that guide pops up there. Within
we're
that,
talking about the guidelines for compliance, aren't we? Yeah.
Yes, we are.
Yeah.
And also within that, there's links to other IR35 guidance. So earlier guidance that HMRC have published. I would say that the Guide for Compliance 4 is perhaps the most comprehensive and useful set of guidance. It brings together lots of information in one document.
And we actually touched on those GFCs in a previous On Top of Tax session, and also in our How to Be a Large Business event earlier this month as well. They're full of really, really practical help and insights as to HMRC's expectations to mitigate tax risk. And there's some areas in there that lend themselves to checklists for businesses to support their compliance too. Okie dokes. I think let's move on to our final slide, I think, for today. So just a little bit on how you can stay up to date. We've got a monthly On Top of Tax newsletter where you can get a monthly roundup of the most important tax updates from us, plus invitations and opportunities to register for our various webinar series. And you can also, for quick updates and insights, join our On Top of Tax group on LinkedIn, where again we share quite timely BDO tax news. So if there aren't further questions, we've got 1 or 2 minutes left. So just to draw things to a close, but before we do, just wanted to say a huge thank you very much for your support for our events through 2024. Hope you all enjoy the festive break, and we look forward to seeing you again in 2025. Thank you very much.